Afternoon, Chris. Lovely to see you on this mildly nice day in autumn. How's things?
Very good, yeah. Third of October already, unbelievably. Where's that come from? But I mean, my goodness, we've come off a pretty remarkable September. And to be honest, it's kind of interesting to be in the final quarter of the year because we can start thinking, how is 2022 going to finish? And even more importantly, how is 2023 and the rest of the 2020s going to move on? Because it's certainly been an interesting last few weeks and, let's face it, overall last 9 months.
Yeah, absolutely. And let's hit some of those interesting times head on. So the great U-turn that we've had over the last day or so, changes to the budget already. That's no shock though, is it, Chris?
To be honest, it was the sensible thing to do, clearly. I mean, the mini budget, I always thought a mini budget would be an almost irrelevance. You know, a proper budget was fair enough for it to be a big thing. A mini budget was meant to be just a mini thing, but it wasn't. It turned into significant volatility in the financial markets, uncertainty, Bank of England, special statements, uncertainty in the new government, and as you say, Rob, a U-turn on the first full day of the Conservative Party conference. So interesting times to say the least. Was it the sensible thing to do? Clearly, absolutely yes. It's noteworthy that the pound has recovered a little bit. It's still been a weak pound over recent weeks and months, but it is a little bit better versus where it was a few days ago. So a little bit of signs of common sense occurring there. What does it mean though for the UK economy? Should we be worried about a recession? What's happening with inflation and stuff like that? That debate still continues. I'm still optimistic that our fears about inflation are kicking around at their peak moment, and I think that story is going to become better as the next few months and quarters occur. The trouble is, unfortunately, less worry about inflation probably also means more worries about a lack of growth or new jobs being created and stuff like that. So there's still plenty of things to be aware of. I'm hoping that Mr. Putin finally gets a little bit of common sense and starts to move us away from some of the high extremity issues around Ukraine and Russia. We shall see on that front. But as I know you've observed before, Rob, if we do get a warmer winter, that will benefit us all on that front. So we shall see how that progresses. But at least the UK government is still attempting to try to help in some way and shape and form, particularly with energy and gas prices generally. And I'm still of the view that at least 2022 has been a year where the world of COVID-19 has started to move away a little bit from us. And that's a good thing in terms of growth and creation of jobs and matters like that. So for all the bad news out there, there is some workable or good stuff. And for me, it still leaves us at least an opportunity to progress forward as we move not only the finish of this year, but into next year and beyond.
Yeah, absolutely. I think you're right, though, as well, Chris, that volatility is very apparent at the moment. And it is the day-to-day investor that is taking the brunt of that at the moment in regards to, their pension and investment valuations. Clearly, it feels at the moment that the stock market's running on a real fine line, and any news that comes out, good or bad, it has a real material impact. When was the last time you've seen markets like this, Chris? Thinking back over your 20, 30-year career, is this something that you've seen before?
Worryingly, yes. We can all probably remember an element of it 2.5 years ago with some of the early days of COVID. Admittedly, during those early days of COVID, you only had equity market volatility and bond markets were performing better. That's what normally happens with, of course, markets. You have equities doing one thing and bonds doing the reverse. And that was always the way it was. Of course, clearly what's been different about 2022 is that both equities and bonds have been volatile for slightly different reasons, but obviously not good news for any pension fund holder or investor generally. Have we seen that before occurring? Absolutely. The last time that really happened with any materiality was back in 2008. But I can remember it at other times as well, worryingly, over the last 20, 30 years. So it's not completely unknown, but it is certainly different, very different from the norms of the last 10, 15 years. And I guess that's what's naturally concerning all investors. Here's what I think. What's important for any investor is, number one, Please don't panic. That's the usual advice, and I think always sensible ones. Number two is to think about the future. That the future is always the critical thing, and what's gone has sadly gone to some extent. We must always look forward, and when we look forward, as I've said before, and no doubt will probably say again, the world is not an impossible place. There is still things to be pleased about. There is going to be volatility. Unfortunately, that is the norm of financial markets. But with careful selection of investment choices, there are things still to be doing. And the world is still, I believe, as we move through the rest of the 2020s and into the 2030s, is going to be a better place. And on that basis, what's the alternative to investing your portfolio in a nice selection of investments? You could put your money under the bed, but we all know that's probably not a smart thing to do. It's certainly not smart to put all your money into the housing market. Great to own your own house, but probably not smart to have multiple houses all around the world or something. I guess you could spend all your money on buying holidays or cars or new sofas or whatever it might be, but there's only a limit of those things you can ever do. And clearly, it's nice to have something which plays the medium to longer term, which is back to your pension and your general investments. And it's always a medium and longer term game, the world of investment. And certainly when you're thinking about your retirement, your longer term planning issues, the investment markets are still, in my opinion, a best place to go. A nice selection of them, carefully selected and chosen, and of course reflective of your personal requirements and situation.
Yeah, absolutely. That is the key, isn't it? What is the alternative at the moment? And I know it's easy to say that cash is performing better than assets, but as you've said, you've got to think about the future, the next 2, 3, 5+ years, and what's that going to look like from an investor's point of view? Then, Chris, clearly there's a lot of volatility going on in the markets at the moment, and for those clients that are thinking about maybe making that knee-jerk reaction, there's plenty of stats that we've seen out there where if you miss the best 5 days or the best 10 days, that you could be substantially worse off than just staying the course. What's your take in that position, Chris? What have you seen as a former fund manager on days? Have you seen days that really do count towards your total returns, and if you'd missed it, you really would have shot yourself in the foot?
Yeah, statistically, that is absolutely true. And certainly, as you say, Rob, when you look at the worst 5 days or very tricky 5 days and compare those to, interestingly, what happens if you sort of could avoid those, or actually if you fail to be invested in sort of some of the better days, it really does make a big impact on your portfolio. So it's very hard to obviously avoid the bad days and just get involved in the good days. That's an almost impossible thing to do, which again brings us back towards the importance of medium-term asset management. That's always the big driver. So statistically, have I seen it before? Of course. For me, what I've also seen is actually people who decide that if the investment markets are impossible, we're not going to get involved. And actually what they do is they sell at the bottom, and then by the time they've got comfortable again, they're buying near the top. And even though markets are not just going down or up or down or something, there is always some medium-term themes to be trying to capture. It is very simple across an individual investment or an area or an allocation to unfortunately miss all the good times and actually panic during the bad times, and mean that you don't actually get involved in any of them. And as we've talked about, sadly, as we can all find out from our bank accounts, you're still unlikely to hardly make any return from putting all your money into cash. You're certainly not going to keep up with inflation, and it's certainly not a wise thing to do from the perspective of looking at your pension fund or other investment choices over the medium term. So we're still back to the world of investments. We're still back to the importance of good choices, of active management, of being careful and reflective of what we need, but also for being involved. And we're back down to a theme we've talked about many times before. The glass is always half full, it's not half empty. And so if you keep that in mind, you can get away from the worst points and capture hopefully many more of the good and better areas and better backdrops. As I say, I'm feeling good still about the 2020s. It's not impossible out there. And frankly, if we thought it was impossible, then I think probably we're worrying too much.
Yeah, no, absolutely. Fear is the greatest fear, isn't it, Chris?
Absolutely, that's right.
Yeah.
All of these great sort of quotes from US presidents or great investment thinkers and the like, you know, they're marvelous things to think and say, but actually it does show an importance or a relevance which all investors, even experienced professional investors, they do find that actually it's easy to be fearful in times of volatility. And back to, again, the words of Warren Buffett, one of the greatest still alive investors in the world in his 90s, it's better to be greedy when others are fearful and fearful when others are greedy. At this moment in time, certainly we're in one of those moments where it's better to be greedy when others are fearful, and consequently staying invested, or if possible, thinking about opportunities to raise investments, if that's applicable and relevant for your medium-term choices, is the right thing to do. I certainly would, as an ex-professional fund manager, would certainly be thinking if I was managing a pension fund, that would be the smart thing to do, looking for opportunities, not just for saying, my goodness, we need more cash and need to move away from all investments. I think that would be the wrong choice to make.
Brilliant. Just to quickly finish us off then, Chris, last quick question for you. Investors have seen what's been, a real challenging and horrible year, if we use plain English, 2022. Let's fast forward 12 months. We're here now in October, November 2023. Do you think we're in a better position than where we are today? I know we've got challenges that we've got to overcome, but as an investor, to give a bit of light at the end of the tunnel, can we be in a better position, do you think? And I know you haven't got a crystal ball because we'd both be on the beach, wouldn't we?
Absolutely. I would hope we are in a better position. Here's why. Two things. Number one is, what are the big concerns at the moment? We've got geopolitics, which is obviously centered on Ukraine and Russia, quite sensibly centered on there, and a little bit of China maybe. Do I think we're going to be in a better position now? I think we are. I think finally Mr. Putin is going to get a little bit of common sense and we will progress that area. Number two, we're worried about inflation. And as we've talked about already, I think we are just actually a few months away from people actually saying, hang on, inflation's actually not quite as bad as it was. We can see some signs of that already, but we haven't sort of seen it in the general economy yet, but that is upcoming. So I think the sort of geopolitical inflation fear level would be starting to move away. What we'll have to be thinking about is, what is growth feeling like? What's jobs feeling like, and matters like that. These are things which always take a little bit longer to sort of move into sort of recovery zone. And clearly, if we've got this fear about recessions, clearly these are the last things to move. So my guess would be, in a year's time, we'll still be thinking about what's growth out there, what's job creation out there. We'll be thinking less about geopolitics and inflation. You put all of that together, and the financial markets will be saying, hang on, there's a chance that we'll be starting to think a little bit more about recovery and growth over the upcoming year. And the wonderful thing about financial markets is you always look forward. And there's a big debate about how long that is, whether it's 6 months or 12 months or 18 months ahead, or maybe even more. All my guess would be is that by the time you get to this point in 2023, we'll be thinking more about a better future, probably much more than we are currently thinking about even today. And so consequently, would I expect financial markets to be in a better position? My guess would be yes. However, the most important aspect will be still your choice of investments. This is where investment managers, investment advisors and related can make a really big difference. This whole active management selection aspect, which is you don't buy a bit of everything, you pick and choose your investments carefully. And we're at that point where it is super important for financial markets. And my guess is that's not going away for the rest of this decade. So I think good news for investment thinkers, less good news for computers alone, if they just make a decision on your behalf, a bit of everything and everything will be all right. That's worked quite well over much of the last 10 or 15 years. I don't think it's going to work well at all over the next 10 or 15. But that's fine, because for any of us who've been around for a bit too long and thought about the 1980s and 1990s, an early part of this decade, this is what we're sort of familiar with and used to, that sort of backdrop. So I guess what I'm trying to say for all investors is there are things to be thinking about, but there are things to be doing too. So I'm feeling good. I'm feeling okay about opportunities as the 2020s progress. So on that basis, I'm hoping October 2023, there's a more positive tone to people's thinking.
Great. Excellent. Thanks, Chris. Thanks for that. And it's going to be November next time we sit down and have our monthly calls. So yeah, and then after that, it's going to be Christmas, believe it or not. So it comes round quick, doesn't it?
It does, and we've got to get through Halloween first. So long as there's not any apocalypse through that, we look forward to chatting to you in November.
Brilliant. Thanks, Chris. See you again.
See you soon.